Hello everyone, I am Jayashree from first year MCom, Department of PG Studies in Commerce, Government First Grade College of Arts, Science and Commerce, Sira. Subject Advanced Financial Management. Topic Portfolio Optimization Strategies. First of all, I thank you Tirumala sir for giving this great opportunity to present this topic. First, we know the introduction. An optimal portfolio also takes into consideration an investor goals and their comfort level with risk. The objective of portfolio is to achieve the frontier, which consists of portfolio that offer the expected return for each level of risk. The picture is represent diversification, spreading money across different investments that reduce the risk of being too concentrated in one investment. We know the meaning of portfolio optimization. Portfolio optimization is the process of selecting an optimal portfolio out of set of considered portfolio according to some objectives. First, we know the meaning of portfolio. Portfolio means diversified investment or want to spread our investment capital across variety of assets like stocks, bonds, gold, real estate, cash and cash equivalents or any other financial instruments or assets. In other words, portfolio optimization is a formal mathematical approach to making investment decision across a collection of financial instruments or assets. Is called portfolio optimization. The picture is represent diversified investment in variety of assets like stocks, bonds, commodities, exchange trade funds, real estate, cash or cash equivalents, NFT, cryptocurrency, etc. Portfolio optimization strategies. First one strategy, asset weighting. When optimizing your portfolio, you assign an optimization weight for each asset class and all assets within that class. The weight is the percentage of the portfolio that concentrate with any particular class. For example, say we weight stock at 10% and bond at 20%. This means bonds are twice as important to our portfolio as stocks. So, we could then assign subweight to slow growth stocks and fast growth stocks at 20% and 10% respectively. You assign asset weight based on your risk and return tolerance. If you opt to minimize risk, you would assign greater weight to low risk, low growth asset. This is what we have done in the above example by assigning twice as much weight to safe investment as profitable ones. Next, second strategy, selecting weight for optimization. Determining asset weight is where value judgment impact the optimization process. You need to consider your investing goals, how many years you have until retirement and your risk tolerance. Once you have made this personal assessment, you will assign weight to different asset classes that keeps risk and return preference in balance. You are seeking what some investors call the efficient frontier, the maximum amount your investment can earn given your established risk level. For example, if you decide you are comfortable with a 20% risk of loss, you want to build a portfolio that can make the most money possible without exceeding that threshold. Third one strategy, calculating asset weight. Now, we need to calculate our weight in non-optimized portfolio. We might place too much money in bond ABC that reducing our possible returns, or over-investment in stock XYZ while would create too much risk. So, we need to calculate exactly how much of each stock we want. Fourth one strategy, a theoretical optimization. Our optimized portfolio will have 60% of it asset in bond ABC, 10% in stock XYZ and 30% in TUV, this lets invest 10% of our money in high risk, high performance potential stock XYZ while maintaining a comfortable 20% risk profile. Remember, this is a highly simplified example. Professional investors use far more complex formulas than a simple average to weight their portfolios. But no matter how advanced the math becomes, it boils down the same basic principles. Smart advisor build a formula to allocate set percentages of their capital into risky, high reward assets and safer assets. Then fifth one, strategy, time strategy and optimization. Investors optimize their portfolios to maintain a risk reward balance that meets their current needs. To do this, they must regularly change the composition of a time sensitive portfolio. Investor may be much more open to risky assets when they have many years to earn money back with an asset loss value. However, if they are close to retirement or the year the child will start drawing on a college fund, they probably can't tolerate so much risk. That's because there is less time and portfolio flexibility to manage losses. Sixth one, strategy, the bottom line. Portfolio optimization is an important part of creating an investment strategy and managing it. Over time, it requires a sensible assessment of your desired returns, stage of life, risk tolerance and investment preference. Once you have established these values, you can work up numbers and percentages that reflect and hopefully support them. Many investors can create and execute a portfolio optimization strategy on their own. That said, many more rely on professional help or algorithm to do this important work satisfactorily. Advantages of portfolio optimization. First one, risk management. Risk management. Portfolio optimization helps to reduce the overall risk associated with portfolio by diversified investment. Investors can minimize the impact of individual security or market fluctuation on their overall investment performance through careful assets allocation. Second one advantage, efficient asset allocation. Portfolio optimization ensures investments are allocated to maximize the use of available resources. It helps investors avoid over or under investing in specific assets or sectors, thereby leading to a more efficient allocation of capital. Third one advantage, enhanced returns. Investors can aim for higher return than a non-optimized portfolio by strategically selecting assets with higher expected returns and combining them in an optimized portfolio. Optimization techniques also help identify investment opportunities that align with the investor risk profile and return expectation. Fourth one advantage, tax efficiency. Portfolio optimization can also consider tax implications and help improve tax efficiency. Investors can minimize their tax liability when carefully selecting the assets and considering tax characteristics such as capital gains, dividends and tax rates. It can result in higher after-tax return and improved overall portfolio performance. Fifth one advantage, rebalancing disciplines. Portfolio optimization provides a systematic framework for portfolio rebalancing. Regular rebalancing helps maintain the desired assets allocation and risk profile over time. It enables investors to stay on track with their objective when they regularly review and adjust their portfolio's composition based on changes in market condition. These are all the advantages of portfolio optimization. The picture is represent also diversified investment. Then we know the conclusion. Overall, portfolio optimization with quantitative analysis has a bright future. As technology continues to evolve, investor can benefit from the use of machine learning, artificial intelligence powered investment platform and data analysis to make better investment decisions and improve their portfolio performance over time. So, overall, the portfolio optimization helps to better management our investment capital. So, that reduce the risk of loss and then better or maximize their possible return in future. So, thank you so much.